Hello, everyone, and welcome back to our Tanker Market podcast. I'm your host, Trisha, and I'm thrilled to have you join us back for part 2 of our discussion in Oil Market and Flux Key Questions for 2025. Last time, we explored a lot of topics from OPEC's current future strategies, geopolitical risks, and even touched upon price wars. So if you haven't listened to our part 1 yet, be sure to check it out for the full context. So now I'm very excited to welcome our very special guest back. Sandesh, thank you for joining us again.
Thank you, Trisha. It's pleasure to be back once again.
All right, so without any further ado, let's jump on to our next set of questions. The question for you, Sandesh, would be more like your opinion on what's your outlook for US oil production, particularly from the Permian Basin. Do you think we are at our peak production levels?
Well, Trisha, thanks for the question. When we say the outlook for US oil production, and you have specifically asked for Permian Basin, I think the production levels and the complexity will be there in the 2025. While US shale production continues to grow, specifically in the Permian, the rate of growth, that is the growth in the production of crude oil, has slowed in the recent years. The most productive drilling areas in the Permian, they are beginning to show signs of maturity, and that too with the increasing cost and lower returns from new wells. The recent surge in production from the Permian, it has been driven by efficient operators, but it has a high drilling cost. And mark my words, this cost is increased by around 22 to 28%. So there are different wells that are present in the Permian Basin, and from this well to well the cost is different. But the important factor is that within 2 years we have around 30% increase in the cost of production. Well, having said that, in future it could again a reason for constraining further growth. Now, when we are speaking about the oil production in 2025, we have to see the comparison between the 2016 and 2025. Because in 2016 we have President Trump elected at that time, and now again he has elected once again. So in 2016, what we have completely different sort of economic and industrial functionality present at that time. So at that time, the interest rates was lower. We just came out of recession, and at the same time, the small scale operators, those are present in the Permian Basin, those are very keen to increase the production because the interest rates were almost 0%. So a lot of capital was available in the market. So what happened is these small scale operators, their core objective at that time to increase the production, increase the value of wells, increase the value of the basin they own, and then sell it to the bigger producer. But right now, that is not the case because now the interest rates are almost tripled and the less capital is now available in the market. At the same time, we have seen some consolidation and mergers in the oil industry since last 2-3 years, specifically after the COVID, and that is wipe out significant amount of small producers in the market, specifically those who are working in the Permian Basin. At the same time, if we want to see the larger picture, the Chevron and Exxon, they have stated that they will plateau the production. So that means there will not be a significant increase in the US oil production, specifically in the Permian Basin. The other important thing is that US shale oil production has grown massively since last 5-6 years specifically. And we have seen the EIA data which says that the production now exceeds 13 million barrels per day. So any additional production need should be there in the global market. And now we are seeing that China and all the other countries, they are going to slow down. So there will be a demand constraint in the future. Additionally, with oil prices fluctuating between 70 and 80 per barrel, there is a limited room for aggressive expansion unless prices rise further. The prices 70, 80, kind of a happy situation for both producers and consumers, because for producers continue their production and sales or exports. At the same time, consumers continue to make impact in the market in terms of importing crude oil from different areas of the world. But if the price increase substantially, that is, price will, let's say, goes to around $100, $110 per barrel, then such price result into demand destruction. And if that happens, then there will be a lesser imports from the consumers, specifically from India and China, because those are the price sensitive countries. At the same time, talking from the point of view of US shale oil production, the break-even price for US shale oil is around $60 to $65 per barrel. And that is different if you collect the crude oil from different parts of the shale basins. So even crude oil prices going down below $40, then there will be a kind of a backdrop for the US shale oil products, because they will be making losses on that particular sale. So the prices remaining between $70 to $80 per barrel, it's a kind of a win-win situation for over the globe. Now, having said that, US shale production is getting declined, specifically in the new wells. We have already discussed in our previous or the part one of this series. And having said that, the production is declined because the wells are getting gassier. And even some of the wells, those are already present, but they were idle since last 2-3 years because of not significant demand present in the market. Those wells particularly not providing such support for the US crude oil production. So overall, if I have to say, the production will be challenging for US shale oil. Another factor or another critical factor, if I have to say, for the US production is in 2025, there will be competitive edge between the global players, and that includes players like Saudi Arabia, Russia, who are the traditional crude oil producers. But at the same time, we may also see the competition from the nearby countries like Guyana, Suriname, or even Canada. So US have to keep themselves very competitive, because these are the different grades US already producing. Well, the situation in the Permian is also influenced by the increased global competition, and this time it is from the buyer's point of view. Let's say the example of Dangote Refinery. So Dangote Refinery is growing importance in the sourcing of US oil. It will be a kind of an influential thing for the Permian production, because as demand for the US oil rises from both traditional and emerging markets, the Permian's role in the meeting that demand will likely remain crucial. Although peak production is a possibility in the near future, technological advancement and ongoing efficiency gains, it could delay that timeline, though at a higher cost per barrel. So having said that, ultimately the Permian is entering a phase where growth will be more incremental rather than explosive.
That was very rightly pointed out, Sandesh. All right, now let us also talk about the relationship between the US dollar and oil prices changing. So, what do you think? How is this relationship playing out, and what might this mean for oil prices going forward?
Well, historically, the US dollar has maintained a positive correlation with oil prices. And when the dollar strengthens, oil prices tend to rise as the cost of purchasing oil in other currencies become more expensive. Having said that, however, recent trends indicate that this correlation is shifting, with oil prices and the USD starting to move in opposite directions. So, in the recent months, we have noted that oil prices are moving lower even as the USD strengthens. And it is a rare occurrence that reflects a potential turning point in the global financial market. But we think that it is kind of influenced by Chinese crude oil demand. And having said that, while many oil market participants, including the long-term bulls, they were discouraged by the current low prices, but some see this as a temporary situation. So the stronger USD has contributed to the recent downturn in oil prices, but it is expected that as the dollar peaks and begins to weaken, oil prices could rebound. As the USD approaches its peak, we see a cyclical low in oil prices, and it will be expected once again. And once this occurs and the USD start to lose the strength, the negative correlation between USD and oil could cause a significant price recovery in the oil market. Some of the bulls are cautiously optimistic because this potential turnaround, they believe that the strength in the physical oil market, such as in the margins and spread combined with a weaker USD, it will support a future surge in oil prices.
Well, that was rightly said. Well, now moving on, we have seen that Dangote Refinery has come into the picture recently. So tell us, Sandesh, how has this refinery's approach to oil sourcing from US and Nigeria evolved?
Well, Trisha, thanks for the question. The Dangote Refinery is Africa's largest oil refinery, and it has a capacity throughput of 650,000 barrels per day. Now, having said that, this refinery has adapted to procure crude from the domestic market, that is through NNPC. So it has designed to process the sweeter crude. It is produced from Nigeria, and it has an agreement with NNPC to supply that particular crude. But what happened in the last few months, because the refinery started operation in the mid of 2023. So initially they started purchasing crude oil, that is the sweeter oil, specifically from NNPC, because they have a long-term contract with them, and NNPC domestically produced the crude from the various field in Nigeria. Now a time comes when NNPC was unable to provide crude because of lot of supply chain disruptions as well as decline production. So at that time, a refinery, it should take its economic decisions because they have to run economically very well. They want to keep their EBITDA positive. So they need to change their supply strategy. So they went to US because the US sweeter crude is directly competitor of Nigerian crude. So what they did is initially they purchased a significant amount of crude oil, but they typically receiving one or two super tankers of US crude oil per month. However, by mid-year in 2024, the refinery began to reduce its imports of US oil, and then it reflects the reliance on Nigerian domestic crude oil. So this shift, it was particularly or the partly due to a deal that allowed Dangote to receive up to 400,000 barrels per day of Nigerian crude paid for in local currency. And they have done this particular arrangement to win over two situations. First is to reduce reliance on the foreign crude oil, at the same time to reduce the foreign currency. That is, if they have to purchase crude oil from the international market, they have to use USD. And since now they were started using from the NNPC, they can import this particular crude through Nigerian Naira. But having said that, however, as of November 2024, Dangote Refinery purchased, that means they have again shifted their reliance from, because it is a strategy, so they have to go back and forth to import US crude oil. Having said that, however, as of November 2024, Dangote Refinery purchased its first shipment of US oil in 3 months. So that is from the September, October, November 2024. They purchased their first cargo in November. And this indicates a shift back towards US imports. This particular purchase approximately equates to 2 million barrels, and the crude grade was WTI Midland crude, and it's supplied by Chevron Corporation. And it reflects the refinery's growing role in the global oil markets. Now, the return to US oil is likely influenced by lower shipping costs and the refinery's continued ramp up in production. Additionally, Dangote's increasing presence in the both US and European markets, along with its exports of refined gasoline to neighboring countries like Togo, it is overall reshaping regional fuel markets and increasing competition for oil traditionally sourced by European buyers.
That was well said, Sandesh. Now, it definitely looks like it's something that we need to look out for in 2025. So, all right, now as we approach 2025, Sandesh, tell us, what do you think would be the overall outlook for tankers?
Well, Tisha, thanks for the question. Thanks for asking me outlook for tankers. Well, if I have to give my opinion, the global tanker market has seen a strong growth in 2023 and 2024. And this growth was supported by the rising energy demand. At the same time, we have seen shifts in trade routes, shifts in trade patterns, and the growth in the refining capacity. So, just to quote some numbers, global refining capacity is projected to grow from 103.5 million barrels per day in 2023 to around 114 million barrels per day by 2030. So, it is a significant growth in the span of 7 years. But however, only 60% of VLCC available, or we can say tradable fleet, is available to cater this increased demand. So you may ask where the remaining 40%. So we have already 4.1% of fleet is under sanctions. So when we are saying 60%, so it is 60% is a tradable. So when we say tradable, that means any competitor or any trader or anyone who wants to use VLCC, it can use this 60% VLCC. Now coming back to the remaining 36%, the 18% VLCCs are already on the watch list. Now, who is watching this fleet? So we have discussed earlier that OFAC is watching this particular 80%, 18% of VLCC. Now we have another 18% fleet restricted, and this restriction is due to the age-related limits. So we have 18% of fleet which is over 20 years of old. And since some countries have restrictions not to use beyond 20 years old vessels, so we have to also keep a look on this particular 18% of fleet. Now, having said that, the order book isn't even a great picture, because right now we just have 45 new ships on order, and it represents 5.3% of total fleet, because we have 850 VLCCs trading globally, including all the vessels. And even this 5.3% of the fleet, the deliveries will not be begun until late 2027. So we have a challenging situation, but it is kind of a good thing, or we can say a kind of a positive thing from the owner's perspective, because it could put upward pressure on freight rate. Having said that, the geopolitical events and the longer trade routes, that means due to geopolitics, we have seen the shift from the Red Sea to the Cape of Good Hope, and these particular ships, those are increasing demand for shipping capacity. That means we have additional ton miles, we have additional engagement of ships. So the trade ships have added around 5 to 10% of more ton miles to existing routes, and that's why there is further strain on the fleet. So that's about the crude oil tankers. Now moving on to the CPP tankers, that is clean petroleum product tankers. So the trade is expected to grow in the future also. In 2023, we have seen a growth around 4.4%, and the total 877 million metric tons was traded in the global market. While this growth is driven by the rising demand for gasoline, diesel and jet fuel. So the growth is significant, but this is coming for this particularly three types of fuels, and it is majorly coming from the jet fuel. However, the market may face pressure from a large number of new LR2 tankers on order, and it could impact freight rates as a fleet growth outpaces demand. So we have a kind of an inverse situation when we compare both the segments, that is crude and CPP tanker segment. We have a lowest order book for VLCC segment, but at the same time we have a highest order book present for LR2 segment, and both vessels are the large vessels in the segmentation category. Now let's focus on India for a bit. The India's crude oil refining capacity is expected to rise from 254 million tons per annum in 2023 to around 435 million tons per annum by 2030, and it is expected to grow by 6.64% year on year basis, that is the CAGR. So the domestic crude oil production is also declining. We may see a further fall into this domestic crude oil production, and it equates around expected 3 MTPA fall in the Indian crude oil production, and it highlights the supply challenges. So crude imports are expected to rise sharply, and it may rise from around 225 million metric tons per annum in 2023 to surpass 400 million tons per annum by 2030, and cumulatively it is around 81.4% increase, and it's a massive increase. The India is also major CPP exporter. We have our exports set to grow from around 50 million metric tons per annum in 2023 to around 77 million metric tons per annum by 2030, and this growth is largely driven by demand for products like gasoline, diesel, and jet fuel. So similarly, like globally, we have also seen the demand for these three products, and even in the Indian context. So CPV production in India is projected to grow 60% by 2029, while the consumption is expected to rise 64%, and it reflects strong domestic energy needs. At the same time, India's LPG consumption is also growing rapidly, and it increasing from around 29 MMT in 2023 to around 44 MMT by 2030. And this LPG demand growth mostly fueled by the household demand and the government's clean energy. Now talking about LNG imports are also set to double. It may grow from around 22 million metric tons per annum to around 46 million metric tons per annum by 2030. Now this growth is driven by rising industrial demand and efforts to increase natural gas use. By 2030, India is expected to handle over 524 MMT of cumulative LNG import. And if they want to achieve that, significant investment in tankers and port infrastructure to be persist, because at the end we want to achieve this target. It's a realistic target, but the investment in tankers and port infrastructure is must. So if I have to give the summary, the global tanker market is growing but faces challenges from freight shortages, geopolitical shifts, and the infrastructure needs. And India is a major driver of growth with rising imports and exports of crude. The trend highlights the need of more ship, better infrastructure to meet future trade demands.
All right, thank you so much, Sandesh, for your detailed insights for all of the sectors, including crude, CPP, LPG, and LNG, and for answering all these critical questions that will be definitely shaping 2025.
Well, Trisha, thank you for inviting me. It was a great session. You have asked some of the key questions. Thanks once again for inviting me. Thank you.
Thank you so much, Sandesh. And I guess that brings us to the end of today's episode for our series, Oil Market and Flux Key Questions for 2025, for both Part 1 and Part 2. And to all our listeners, thank you so much for tuning in, and do not forget to share and subscribe to our episodes. Until next time, navigate safely and